Welcome to Fear and Greed, the week ahead. I'm Sean Aylmer, and as always, I'm joined by economist Stephen Koukoulas. You'll find him at thekouk.com, Thekouk, thekouk.com, and on X using the handle thekouk. Stephen, good morning.
A very good morning.
Now, Stephen, I don't make too fine a point on it, but I reckon you've done not much in the last week. You've had a weekend off. There was no economic data out last week. Nothing happened. Well, that's not quite right. We had some Reserve Bank board minutes were actually sort of interesting given this week's CPI figure. But have you relaxed? I suppose that's where I'm getting to here.
Sort of relaxing. Yeah, there wasn't much out. There were bits and bobs from overseas. You know, we had NVIDIA results during the week, which, of course, everyone's very excited about because it's such a big company. But at the end of the day, that sort of was not really that big anyway. So a lovely quiet week. I've had a chance to over the weekend to watch the cricket, which has been very exciting, of course, now that the horse racing sort of dying down a little bit. And ready for this week, which will be an absolute beauty.
So, on that, the monthly CPI figures are out this week. What do we think about that, particularly given what the Reserve Bank board minutes said last week about needing 2 quarters of lower CPI to make a change?
Yeah, the board just sort of put a little bit more flesh around those bones that we've been hearing from the governor and other senior RBA officials when they really want to get that trimmed mean underlying inflation rate lower, and also the headline rate lower for longer too, I think is what they want to see. So the monthly figures are sort of interesting. They're important. They're another little tick along that timeline of lower inflation. And interestingly, for the numbers that come out later this week, market expectations are for an annual increase of about 2.3%. So it'll be the third month in a row that it's been within the 2 to 3 target band. Now, we all know it's largely, not exclusively, but largely due to those electricity subsidies trimming quite a bit off. So the trimmed mean measure is probably going to be a tick or two above 3%. So the RBA will be probably content, but not convinced that that's the trigger they need to cut rates.
I noticed last week National Australia Bank and Westpac, the economics teams of both those organisations, Westpac, of course, is Lucy Ellis, who used to be the chief economist at the Reserve Bank. They've pushed back their forecast for rate cuts until at least May. I mean, NAB said May, Westpac said at least May.
They have, and I think many others in the financial markets are also pushing them back. And I think finally that rhetoric from the RBA is sort of gaining some traction with them. But also what we're seeing from overseas, the Trump election win has seen US bond yields and even US monetary policy expectations being scaled back and pushed further into 2025, partly because of the inflationary effects of what we think he's going to deliver, tariff increases and great big company tax cuts and the like, which are very stimulatory for the economy or inflationary. So the US market's been, in a sense, providing the lead. The local market's been following suit. And again, we should remember that labour force number from, 2 weeks ago now, that confirmed unemployment in the low 4s, 4.1% still. And that's part of the mandate. So in a sense, we celebrate low unemployment. Of course we do. But if it's coming at these sort of low levels with interest rates where they are, the feeling is we don't need to cut rates because we've got the economy rolling along at an okay pace, even though some people are feeling a little bit of a financial squeeze right now.
Okay, capital expenditure figures are out this week. They're the ones that every month when they come out, I say to you, Stephen, please explain them because I just reckon they're hard.
They're hard, but they're fun. what the Bureau of Statistics...
That is the fundamental difference between you and I.
Oh,
right?
I love them.
You are happy to go for the hard stuff, not me.
Yep, these are great because what they basically do, in summary, they reveal how much the private sector is investing in machinery and equipment and buildings and structures. There's a couple of other little bits and bobs, but they're the main two things. So are we building office blocks, hotels, shopping centres, factories, warehouses, or buying computers, lathes, trucks, and these sorts of things for the machinery and equipment? Really, really important part of the economy in any sense. But when you want to get productivity, obviously productivity requires some capital injection too. That's what they show. Now, these figures will show the quarterly change in CapEx for the September quarter. This is one of the building blocks into the GDP numbers. So the expectations are for a very small rise. Last quarter, it fell. So just a little bit of a statistical rebound, nothing big. So hoping it's a positive sign. But they also include, and this is where the fun part is, Sean, the bit that you really get your teeth into, is they have expectations. So the firms say, how much are you expecting to invest in machinery, equipment, building and structures next financial year? So as that number goes up and down, the just company XYZ says, oh, we're going to invest $2.3 billion on machinery and we're going to build a new hotel, whatever. Those numbers go to those expectations numbers. And as they change from quarter to quarter, we get a better feel for what the business sector's thinking about CapEx. So that's why they are important. I know the Reserve Bank looks at them very, very closely, even though they might not be as sexy and as prominent as inflation and unemployment and GDP and these sorts of things.
I'm sold totally. Just before we go, we're out of time, but the Reserve Bank of New Zealand meet this week.
Yeah, quickly on RBNZ, they've already cut rates a few times. They're meeting, and given the economy is in a pretty dire space over there, we're looking for either 25 or 50. The jury's out what they cut, but a cut is almost baked into the cake. It's just whether it's 25 or 50 basis points.
Everyone seems to be cutting, except for us, Stephen.
Except us. We're the Lone Ranger at the moment. Yeah, well, maybe that'll change. But let's see what happens with our local data as well.
Who knows? Stephen, enjoy your week.
Thank you, Sean.
That was economist Stephen Koukoulas, better known as The Kook. You can find him at thekook.com and follow him on X using the handle The Kook. I'm Sean Aylmer, and this is Fear and Greed, the week ahead.